Hello, hello. Welcome to another coffee break. It is 5 things you need to know about a particular topic. And this month, we are going to be talking about savings buckets. You hear a lot when you talk to financial people about buckets that you should be saving to. And these are just a few you could be saving to outside of your 401k. So let me share my screen and we will get going. There we go. All right. So, just as a reminder, our company is One Vision Retirement. We are here to help many people, but this particular series is for those of you who are participating in your 401k already. Maybe you're just going up to the match, maybe you're just getting started with it, or maybe you've got a long time of participating with your 401k and you just want some other ideas. This is really just to help you get some strategies in place to set up for your financial future and make it a really strong basis, a strong base, and how do you build off of that to get to what you want to do, get to your goals. This is short and sweet, 15 minutes max. We're usually around the 10-11 minute mark. I can't guarantee that today, but if I keep it short enough, I will get there, I promise. And just as a reminder, we're just doing highlights. So this is not advice for any particular person or saying, go do this or go get this kind of bucket. We do offer a complimentary, no obligation call. So feel free to reach out to us and we can help you on a more personalized way, figure out what works best for you and your situation. So who is One Vision Retirement? These are Chris and I are kind of the two principals of it. I'm Lisa Sakai. I have 12, almost 13 years of experience working with a lot of female professionals. I've started to niche down working with women who are child-free and either their spouses or independently. And so that's who I work with. I am child-free, so I know a lot about what the planning goes on for them and how they deal with their profession and career and how they can handle their money a little bit better. One of my kind of fun facts is I am constantly listening to podcasts. It drives my husband crazy because I always have some new idea or new something I should be doing. And it's not just financial podcasts. I listen to a lot of health, mental health, those kind of things to kind of get out of the financial world. But so much of that is actually applicable to me helping clients. So Chris is not able to make it again today, but he's got 22 years of experience in the industry. He works a lot with the business owners to help implement financial strategies for you guys, for employees. So he knows a lot about what you want and what is available to you. And he is a huge hockey fan. They moved out to Florida a couple years ago and they became huge hockey fans, and we are too. We're a big hockey family as well. So if you want to talk hockey, you can set up time to talk to us about that as well. All right, so let's start with the first strategy that you can be thinking about, or the first savings bucket. And the first one is your boring checking and savings account. Now, the biggest thing that I get told a lot is, I don't want that. Like, it's so boring. Like, I'm never making any money. There is a reason to have it, though. That is for emergencies. That's the thing that you can go and get money out of the ATM really quick if you need something for an emergency. Should you keep your full emergency fund into a checking or savings account? Probably not, maybe. But for most parts, we usually see that there's a certain amount that you should have set aside for emergencies. In most emergencies, you have a little bit of time to get some money out. So there might be another bucket that you should be looking at to have your money. What is one of those buckets? Well, it could be what's called a high yield savings account. That's our bucket number 2 to consider. High yield savings accounts are interesting because a lot of them are online banks, although more and more of the traditional banks are considering something like this. And what it's doing is it's actually getting you a higher rate of return or higher yield than your traditional bank account. So maybe your traditional bank account is getting you 0.02, or if you're lucky, 0.04. Maybe a high yield savings account is getting you 2 or 3%. Currently, in August of 2023, a lot of them are getting anywhere between 4 to 4.5%, maybe a little higher. You do want to make sure that there's certain things in place like FDIC insurance or SPIC. You want to make sure that they've got all the makings of a bank. And I'm happy to send this to you. NerdWallet also does really good review every month on different high yield savings accounts and lists out all the different ones. So that's something I will send to people all the time, because we don't represent these companies or try to, put anybody in something. It's got to fit for what you're trying to accomplish. But it's a good source to see all the different companies out there that are participating in high yield savings accounts and what they're offering that month. All right, so bucket number 3 is a brokerage account or a trust account. People get very confused about this because we're so used to hearing about retirement accounts like an IRA or a Roth IRA or 401k. This is kind of your basic investment account. There's no real rules or regulations on this. You're opening up an account, basic brokerage account, and you're putting as much or as little money as in there as you want. There's no restrictions of what you can put into it. And basically you pay on capital gains tax on the growth of the account annually. You pay a bigger capital gains tax when you sell out of certain positions. So if you bought a stock, it's grown, and you sell it, you're going to pay a bigger capital gains, but you do have a small amount of capital gains you pay every year on dividends and income and other things that come into the account as well. So it's not a tax deferred account. It's not a tax-free account. It's an account that you pay taxes as you go. And traditionally they are capital gains taxes. Now, if you invest in them and within the year you sell out, that could be income tax. So just as an FYI, it is something that I always tell clients that if you're going to invest in this, try to make sure that you're going to be invested in your holdings for about a year before you make changes. Not about a year and a day before you make changes. So you're getting the capital gains rate rather than the income rate, which the capital gains rate is typically lower for most people. So that's usually a positive to wait that year. Now, a trust account is similar. It's just held in the name of your family trust. So if it's blah, 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 family trust, it's going to be titled like that. And what that means is if it's held in the trust, it's going to flow through the trust. So if anything happens to you, the account will follow the rules that the trust is already in because it's held into the trust. Now, you might want to consider also looking at bank accounts, high yield savings accounts, and looking at how they're titled and what beneficiaries they have. If you have a family trust already in place, talk to your estate planning attorney of how you should make sure your trust is somehow attached to those accounts as well. Now, for the next kind of account, traditionally, if you've got a family trust, you'll put it as a beneficiary. But again, you want to talk to your estate planning attorney because every state's very different on how they want to handle it. And it depends on how your trust is written. So you want to make sure you confirm all that with your estate planning attorney based off of your personal situation. But for an IRA or Roth, these are retirement accounts, but people don't realize they actually have access to these outside of their 401k. Now, with the Roth IRA, you have to make under a certain amount of income. There's income limits. It changes every single year, but there's income limits both for a single person and for a couple. So we'd have to take a look at those numbers and see where you stand on that. But you might be able to contribute to a Roth Roth IRA outside of your traditional 401k or a Roth 401k, whatever you're participating in at work. That might be an option for you. And it might be a good option because you're putting in after-tax money, getting the tax deferred, and then taking it all out tax-free if everything stays the same with the Roth. An IRA is a little different though. You're not going to get the tax deferral that you would get if you weren't participating or even eligible for your 401k. You are actually going to have to put in after-tax money and it will grow tax deferred, and then you take it out. And your original shouldn't be taxed because you've already paid tax on it, but the growth is all going to be taxable. It can be a little bit of a complicated situation because you're kind of commingling tax deferred and not tax deferred money together, but it might be an option if you're trying to put away some money and don't want to pay on the tax and the growth. This might be a good option. So some people like doing an IRA outside of their 401k. Some people don't. They don't think that that's the right choice. So it just depends on your personal situation, but it is a little bit more complicated on the tax side of things. All right. So the fifth point that we're going to go through is what account and when should you do it? Now, I always stress with people, having an emergency fund is very important. I always think having an emergency fund in place before you start doing outside investing is really important, because you're already participating in your 401k. You're already saving someplace, right? Maybe it's just up to the match, but you're saving something. And so therefore, start building your emergency fund out first before we start taking a look at other accounts out there. For the most part, that's the rule of thumb that I tend to use with people, because without the emergency fund, if you start putting into, let's say, a brokerage account or something like that, and then you need to take the money out, well, I just told you that's income tax to you. That's going to get taxed at a much higher rate. Those growth. Now, that growth might not be there very much within the time period, but maybe it's a lot. Maybe that stock that you invested or something went up 24%. That could be a lot depending on how much you put in. So you want to make sure that you have that layer of security put away before you put into accounts like a brokerage account or an IRA or Roth. Those are kind of, I call them accounts that are touchable but untouchable, right? You want to think of those as long-term investments, and your emergency fund is there to help with everyday expenses that come in and out, or things that you forget or you didn't realize you're going to have to pay for. And that emergency fund is not supposed to sit at 3-6 months of savings and just stay there. That is supposed to go up and down. You're supposed to use your emergency fund for what it's intended, which is emergencies, or things that came up, or things that are more expensive than you expected to do, or pay for your trip with that and then fill it back up so that you still have your emergency fund. That's what an emergency fund is really there for. So once you get the leverage of the emergency fund down, then it's a good time to invest in some of those other things. And your emergency fund can sit in your regular checking and savings account, or like I said, one of those high yield savings accounts that might be better fit depending on what you're trying to accomplish. So these are the couple things, the 5 things that you should be thinking about. So 4 different accounts that we went through, and a think about when and where to do it. This is going to be really dependent on what you're trying to accomplish. So you really should get some help trying to figure out what buckets and in what order you should be doing them for your situation. And so in conclusion, where to save can be very complicated, as you've heard. I'm sure this has made your head spin a little bit and you're like, ooh, this is too much information. Take the video, rewatch it, maybe put it on half speed. I don't know if you want to hear me at half speed, but really start to understand how these buckets work, because the more you know about this, the better off you're going to be when you're making those decisions after you have taken advantage of your 401k to the extent that you want to. It's really important to read through fine print on these kind of things to understand how tax works, understand how liquid is the account, when can I get my money out, what's the rules, is there a 59.5 rule, is there not, how much can I put into there? That's really important to know those details. And so if you aren't going to know them, you really should have a financial professional who does understand all that and helps you with that kind of thing. Don't hesitate to get a professional with help on these things, whether that's your CPA, financial advisor, an investment manager, whoever you work with, they should be helping you with this. And if they're not, you need to help get them engaged with that, because I'm sure they're willing to help if you just ask. And a lot of times clients are very shy to ask questions. That's what we're here for. I want you to ask questions because I don't want you making a decision without all the information that you need to have. So if you want to see any past videos we've done, they're at our YouTube channel, which is at onevisionretirement.com. And like I said, you can schedule a call. You just take your phone, open up the photo app, scan the QR code, and you are right there, and you can set up a time to chat with us. And we're happy to do that. And again, there's no obligation. There's no cost for that call. And if you just have a plain old question and want to reach out to us, info@onevisionretirement gets to both Chris and myself. So you can email us there, go to our website, onevisionretire.com, or I am pretty active on LinkedIn. So you can always follow on LinkedIn and see some updates that we put up there as well. So with that, I'm going to let you go. Hopefully you found this helpful for August for saving buckets, and we will be back next week with another topic to discuss. Take care, everyone.